Welcome to the Anton Stentner podcast. And today I have a question for you, Anton. How will DOGE impact the real estate market? And if you don't know what DOGE is, why don't you explain it to us and then how that impacts us?
If you don't
investors.
know what DOGE is, you've been living under a rock. Let's just be really blunt. You're either in love or you hate. There's no like in between on this one. But the majority of Americans can agree we want a more efficient government that spends less money, that gives us a better return on our tax dollars. And DOGE is the Department of Government Efficiency. Elon Musk is helping push that through under the direction of Donald Trump, our current president. And so I've been asked this question a bunch, like, how's DOGE going to affect real estate? What's going to happen with land development? What's going to happen with commercial real estate? What's going to happen with home prices? Blah, 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 blah. I wanted to start with the one I think is actually the problem that is in definite trouble. So let me ask you a question. Who is the largest single tenant occupant of office space in the United States? The number one tenant.
I'm going to say government because I heard that this last couple of weeks because of DOGE.
I didn't know that either. The government occupies 149 million square feet.
But what's crazy is how much of it is vacant.
Bingo.
And not being used.
Yes.
But paying full price.
Yeah, probably paying above full price. You know, the old adage or the story of like, you know, the military has $1,000 hammer. When they know it's the government, they overcharge. So this is $5 billion in annual rent.
Just the vacant ones or just all together?
All together.
Okay, got it. So the ones that we do use,
yes,
included.
Yes. Let's just call it 150 million square feet. And then in the DC metro, this is 33%. Okay, so one, on previous episodes, you, our subscribers, know this. We've talked about how office space was in trouble. We talked about how I sold my office space going into COVID. It was just part of that was luck. Part of that was I needed to cycle some capital. Part of it was I saw the writing on the wall. Now, all of a sudden, with DOGE auditing everything, we're finding out how much office space is actually being used. There are estimates that the government could use between 30 to 60% less office space than they're currently using. So that means the largest single tenant in the United States could possibly only need to occupy 75 million square feet. Wow. Okay, so one, we already know office is beat up. Two, this could cause that major office problem. Three, this is one of those things that creates opportunity. This will create opportunities for redevelopment of office space. This will create opportunities to buy office space at a discount, to repurpose it into another use.
Tell me why it would create hurt in the general commercial real estate market.
Because when you start to pull down really hard on one sector, it starts to sink the whole thing. So it's the rising tide lifts all ships. The problem is office was already down between 20 to 40% in its value.
And so you're saying if these vacant properties that aren't being used gets put onto the market, because that would be the logical thing. You just cut the leases, right? Pay the fee, and then this be like on the open market.
They don't even have to pay the fee, Benji. Over 50% of the government's leases are all cancelable within the next 6 months.
Yeah, so it's worse because
it's
it
worse.
could be
They can
done
kill
like that. And 25% of it.
Bingo. Up to 50% could be canceled, 75 million square feet, within 6 months. There's not enough office demand to soak up that level of inventory.
So just play a hypothetical here. Say they cut 20%, because maybe they need some of that vacant spot for something that's let's just say 20%. What is kind of the domino effect, and then what would be the result of it?
The domino effect is they have to be released at a lower rate in order to keep up with the simple supply and demand, which then could turn into capital calls on the owners of those properties because they're not meeting their debt service coverage ratios.
The ones that own the property, that's leasing it to the government.
Correct. Now, the government owns its own properties too. So the government could sell off to even further exacerbate this issue. Now roll it further upstream. Debt service coverage ratios are now a problem. Your debt is now a problem because debt's more expensive. Okay, so if someone has to refinance, they got to refinance from a 3% to a 7%. They no longer have enough cash flow coming in because they've had to lower their lease payments in order to get the occupant, which turns around and causes the regional banks, the community banks, some of these REITs, some of these syndications to start to fall a freaking part. That's the problem. Okay, flip it over. For us investors, that's also an opportunity. How this is going to play out, don't know. We're going to have to wait and see. But I'm calling this the most enormous real estate opportunity in relation to DOGE, commercial office space. The next thing I want to just bring up briefly, DOGE has talked about this idea of privatizing the GSEs. The GSEs stands for government-sponsored entities. Most of our audience still doesn't know what the hell I'm talking about. I'm talking Fannie Mae and Freddie Mac. Those are the GSEs. The secondary market, which is the GSEs, is what soaks up all of the liquidity. So when Bob and Betty Smith go buy a home and they get the mortgage from Bank of America or from a mortgage broker, that mortgage is then resold to Fannie Mae or Freddie Mac. That's one of the things that causes the liquidity inside the system that keeps our rates low. Well, one of the things that DOGE has proposed is, well, what if we bring these things back to public entities instead of government-sponsored entities? I don't like that one. And the reason I don't like it is because of my own pocketbook. I sell real estate. I own real estate brokerages. We build homes and sell them. If we make it harder for Americans to get a mortgage, that means the cost of debt will go up and the number of transactions goes down. We lose more of the middle class, which everyone knows I'm a huge proponent of that. And it hurts our first-time homebuyer even more.
How does a GSE hurt those parties?
If the GSE is no longer a government-sponsored entity and they become a private corporation again, they can do what private corporations want to do and seek profit first.
Yeah, make more money.
Make more money. They are profitable, but if DOGE cut them, I think it could hurt the liquidity of the real estate market. So I'm not for this one. I'm usually totally for deregulation, not for this one. What I am for is them lowering the number of people that work at HUD, at work at the VA, at work at Fannie Mae, Freddie Mac, Ginnie Mae, and FHA. I know those can be streamlined beyond a shadow of a doubt because I just went in and type something into ChatGPT about house plans. Hey, render me a house plan that looks like this. It can do it. There's no reason it couldn't review a loan application super quick and you could cut out a whole layer of people. But we have to work through that and get to that level of government automation. So, one, I'm not for the privatization of the GSEs. Okay, what's starting to happen though? So I think DOGE is starting to lead towards our economy slowing down. I believe that our economy has been propped up, and if you don't believe me, go look at the GDP numbers and the job growth prior to this over the last year. All of the job growth was in government and healthcare. So what did President Trump and Elon do? They said, no more government hiring, and we're going to cut some government workers off. So that slowdown of hiring in the government, not unemployment yet, the slowdown in the hiring of new government employees is starting to show the problems in the private sector that I feel, that you feel, that our listeners feel, that, hey, this economy is just a little bit harder than what the government is saying. In other words, the government was propping up our GDP by the money printing and them creating their own jobs. As DOGE slows that down, you're starting to see the cracks. And you see the cracks, I'll get into this a little bit more, but the yield curve inverted again in the last week. The yield curve inversion is a sign of a recession.
Oh.
Yeah.
That's a big deal. I didn't know that.
Yeah, yield curve inverted. The yield curve inversion.
Yield curve is a celebrity again?
Yield curve's a celebrity again. Yield curve inversion is when shorter bonds have a lower yield than the longer duration bonds. It should be the other way around.
Yeah, the quick explanation is it's not good and it's a bad sign.
The quick explanation is it has a real high accuracy of predicting a recession. And what I'm going to actually say, and we've talked about it before, all of our subscribers know this, is that we've actually been in a recession for a while. The government's just been propping us up and pretending like we haven't been. I think the Biden administration finished out with a giant bunch of money printing, a giant bunch of government jobs to keep the economy looking good so they could get reelected.
I'm surprised they don't measure those separately.
Well, they do.
They do.
So this morning, unemployment, I want to make sure I get these numbers right. Jobless claims filed last week were 242,000.
Was that part of the government?
This is not the government. This is just regular jobless claims.
And I heard today they were letting people go.
And they are letting people go in the government. So that's 22,000 more than last week. And that's a big upward shift, even though unemployment sits at about 4% right now. So unemployment is still pretty low. But that big shift up in jobless claims means there's more people looking for support. This is the highest level this year. Now let's go to the federal worker, the government employee. The government employee shows up as a different number, and that data will lag by a week or two for its claims to come fully through. It doesn't end up in our regular jobless claims. It's its own number. So mid-March, as the government starts to lay people off, and as people take these buyouts, this government number should also shoot up, which will show further weakening in the economy. Now we're going to move to inflation because we're going to tie this all together here, right here at the end. So PPI components, Nick Temeros, Wall Street Journal. I love reading his tweets. His articles are a little bit longer, but if you want to just kind of get good, quick glimpses, he said, because PPI, which is the producer price index, so CPI is what the consumer pays, PPI, producer, is what businesses pay. That feeds into the PCE, was soft in January. It came in at an increase of 0.27, which is well below the 0.45 increase they thought was coming. And so they believe that's going to lead to a lower PCE, which is the Fed's favorite metric, on Friday. And that will have already come out by the time this is published. So one, even though we've had some higher inflation numbers over the last few months, I believe we beat inflation. Two, I believe shelter inflation is being overreported just by the way we measure it, because we measure it on a 12-month average. Because I don't know anywhere in the country that's experiencing massive rent growth and massive price growth. Plus, these PPE numbers are a precursor to the Fed's favorite metric, saying, you know what, PCE should come in a little bit lighter. So let's assume we've beat inflation. So DOGE is working on government efficiency. We know unemployment is rising. We know the economy is slowing down. So for us real estate people, what does that mean? It actually means rates are going to start to get better. Well, is that already showing up? It is. So the 10-year Treasury peaked on January 13th at basically 4.8. The 10-year Treasury is what sets debt for all commercial debt. So whatever direction the 10-year Treasury goes, that's where auto loans go, that's where student debt goes, that's where credit cards go, that's where real estate mortgages go. President Trump, Elon Musk, and Secretary Bessent have all said in separate interviews over the last few weeks, our focus is on the 10-year Treasury and getting consumers cheaper debt. I believe that the world has already started to notice DOGE. Because remember, our Treasury market is a global market. It's the world buying it. It's not just the U.S. So it peaked at 4.8, and this morning, 4.283.
Give me an example of how the world is noticing DOGE. I understand the sentiment on their end is getting better, and even define what better means and why this is going down.
Treasuries and the stock market are forward-looking indicators, and the bond market is bigger than the stock market globally.
So it's basically what everyone else wanted America to be doing, which is like get your house in order.
Bingo.
Because right now, if you look at the news right now, guess what? When you look at the news, even when you look at X, right, which is Elon's platform, because I feel like he does want like everybody's messages to get out there, the focus is on all the people losing jobs in the government and not necessarily their overall goal for the bottom line, which is like, let's just tighten up the budgets.
Bingo.
Let's cut out the excess and let's try to either at least save money or maybe pay down the debt. So this is where what you're saying totally makes sense. Other countries that holds U.S. debts, they're like, oh, dang, they're finally getting the machine running efficiently.
This is hedge funds. This is other countries. This is a forward-looking indicator where they're basically saying three things. It looks like you're getting inflation under control. It looks like you're getting your house in order. And when I say getting your house in order, I'm going to break that into you're cutting your spending and you're getting your government more streamlined and running like a better machine. In other words, the world is saying, I have faith in the direction the U.S. is currently going. So it's making our debt cheaper. So let's talk real estate for the exact example. Real estate was basically 7.2. This morning it was 6.8. That's a significant movement in
one
mortgage.
day?
No, since January.
Okay, got it. Yeah.
In mortgage rates. That will also start to slowly show up in auto loans, in student debt. And you can see this 10-year Treasury now trending in the right direction. Well, for our regular subscribers, our regular listeners, P.S., if you're on Apple, we need more reviews on Apple. Please give us a review if you listen. I would super appreciate that. But this right here, trending down, says demand is going to go up. So remember, real estate, residential real estate is at a transaction low right now. We're selling about the same amount of homes in the United States as in 1995. And in the Seattle metro, we're selling the same amount of homes as in 2012.
That's a lot of it is rates.
It's all rates.
Oh, and not inventory.
It is inventory because with the really expensive rates, we don't have the move-up buyer, and the move-up buyer generally sells their home and buys the next one, but they can't afford to move into the next one.
With low inventory, naturally, the prices are just staying high as well. But with lower rates, people can afford it. But then it gets tricky because guess what? More demand, more people buying, then the house prices could go up. This is what's so crazy about it. No matter how you look at it, home prices are going up.
No matter how you look at it, bingo, is you're in a sweet spot right now. You're at the point where it appears rates are trending in a downward direction. Therefore, demand will be going up over the next 2 years. And as that demand increases, the velocity of prices going up will increase. So if you're the investor, it's like, okay, buy now. Well, I don't have good cash flow. Who cares? You're going to have to pay a lot more later. Oh, I'm the first-time home buyer. What do? Buy now. Or you're just going to have to pay more later. Oh, I'm a move-up buyer. What should I do? You should rent your first home and turn around and buy another one and then refinance as debt comes down. So I wanted to go to the negative of this. So I went to Reddit, okay? I'm looking through Reddit. Like, what does Reddit think about real estate and DOGE? Okay, one of the things they thought, the foreclosure crisis is going to finally be here. Sorry, not happening. There's too much cheap debt, and foreclosures right now are at like a 30-year low. Second thing Reddit said, well, now that the Trump administration is in, these banks are going to have to start foreclosing on people because they can't keep kicking the can down. No, incorrect. I think the banks learned from the great financial crisis because we lost so many banks, we had so many defaults, that they're now doing workouts way more than foreclosures. They're working through things and changing things and allowing people more opportunity before they go into foreclosure, such as short sale, such as deed in lieu, such as loan modification, such as recasting the debt. Where does this create a massive bright spot? It creates a massive bright spot in multifamily. And here's why. So multifamily starts dropped 24.1% from October and 28.8% year over year. signaling a massive slowdown in multifamily new construction. Now, there are places where multifamily is growing, and it's growing in the Southwest and in the Northeast. But guess what the West saw? AKA Seattle, West Coast, East Coast. We're down 32.7% in permits. So if I'm an investor in my area, I'm thinking multifamily as rates drop. I'm thinking I start land development applications now in 2025 and in 2026, knowing that that project's not going to be finished for 2 to 3 years from now, and I'm going to most likely have cheaper debt, plus there's a massive low. And then we'll throw this up on the screen just so you can see this decline, but realize right now, because this decline is so big, except for in places like Texas and Florida and Utah, that creates massive opportunity in the multifamily space. So there's opportunities that we see. I want to kind of recap this whole thing. I think the commercial office space is going to get even more beat up. That's going to create opportunities with banks that have to unload inventory, with investors that have to unload inventory. It's going to create opportunities for rezones and opportunities for low rent, even for some small businesses to move in. I think that the world is noticing the actions of DOGE, the actions of the United States, getting its house in order, getting its spending under control, and that's why the 10-year Treasury is trending down. Go, DOGE, go. Okay? Not political, but man, that helps my pocketbook personally. Wait a second. It might also help President Trump's pocketbook because he's a real estate guy. It might also help Elon because he sells a bunch of consumer goods. So you have to think about like where are the motivations, always follow the money. And then lastly, this big drop in multifamily, especially here in the West, is a good sign for the future. What we don't like here in the West in relation to multifamily that you just have to be aware of is our eviction laws. I went and looked at a property in Lake Stevens that we can make a cash offer on right now. They're willing to offer it to me $150,000 below market. They've owned this property since the early 90s. When I drove by at 8 o'clock this morning, one tweaker was out playing in her car. One tweaker stumbled out into the road. A third zombified tweaker was walking by. And I was like, what is going on? And then they stopped in the middle of the road, and I was literally there to look at the property. They just walked out of, so I'm just like casually shooting pictures and photos. And what I realized was the verbal 150 grand we got off wasn't enough. So this is another example of this crazy lawlessness, this lack of protection for landlords, this rampant drug abuse and probably mental illness that's definitely not being treated, and they're not being able to find the care they need, running rampant and destroying this person's property value. We're going to have a call later today to discuss 5 options on this property. And the person said, oh, it will only take a few months to evict those people. And I said, ma'am, I'm really good at this, and the last one I did took me 11. And it cost me like $15,000. So that's something we have to do. If we're going to buy this property, we got to factor in major carrying costs, plus brain damage and a little bit of heartache.
So like double the price.
Yeah, like double the price. And so what I want people thinking about is, one, our economy is not perfect. So you got to be cautiously optimistic. 2, you got to prepare for the worst and believe and plan for the best right now. Because I believe overall, even though we're still going to go through some short-term pain, I believe that we're headed in the right direction from an economic perspective that's going to very much be really pro-real estate over the next 4 years and over the next 10 years. Very bullish long run right now, slight bearish short run, but very optimistic.